Zero DT options have exploded in popularity, now accounting for over 50% of the SPX daily options volume. But for mini traders, the fast pace and same day of expiration could lead to oversimplified decisions. Buying just because it's cheap, selling just because theta decays faster close to expiration, and entering trades without a clear reason beyond it's expiring today. This video is here to change that. I want to walk you through the key forces that really shape the outcomes with zero DT trading, so you can move from a reactive trader to something more intentional, cost-aware, and situation-specific. We'll cover the mechanics that matter most, like gamma, theta, and executional drag, and I'll show you how I personally decide when to trade zero DT, why to trade zero DT, and how to trade zero DT, and the structure I use inside of my own trading system. For those of you that are new here, my name is Mark Anderson, construction worker turned zero DT hedge fund manager. I've sold over $50 million in zero DT premium across over 1,000 consecutive days of live trading. Let's get into some of the hidden reasons why zero DT traders don't make money. First, gamma and theta. Let's start with gamma and theta. These drive the entire rhythm of zero DT trades because there's a tug of war always happening between the gamma of your position and the theta of your position. Gamma means how quickly delta changes when the underlying price moves. With just hours or minutes to expiration, gamma increases exponentially, especially for at-the-money option positions. Gamma is what makes zero DT feel explosive. It's the both ends of the sword. As expiration approaches, gamma spikes, which means even a small move in the market can cause a big shift in your options delta. That's why these options can swing wildly up or down within just a few minutes, especially in zero DT. It's great if you're a buyer and the market tanks in your favor, but if you're wrong or just a little late on that, your gamma will also accelerate your losses in the decay of that position. Think of gamma as the amplifier. It magnifies everything, wins and losses. Then there's theta, which is the rate of time decay. Theta measures how much an option price goes up or down as time passes, if nothing else changes. No move in price or no change in volatility. Think of theta like melting ice. Every minute that passes, your option melts in value just because the clock is ticking. As time goes by, the option's time value decreases, and these losses happen faster the closer you get to expiration. With zero DT options, theta isn't working daily, it's working hourly, every minute by minute. By the end of the trading day, an out of the money zero DT option will be worth zero unless the market moves in your favor. Think of it like a rental fee for holding this option. If you're a seller, theta is your edge. It's the premium because you're collecting that rental fee and you keep the option to expiration when it would expire worthless. If you're a buyer, theta is the constant headwind you're fighting. You need the market to move far enough and fast enough to outrun that same time decay over time. And here's the other thing. These aren't isolated forces. Gamma and theta are pushing against one another the entire day. And depending on which side of the trade you're on and how the market moves, they can work for you or against you very quickly. That's why I buy and sell options. So instead of asking, should I buy a call or put today? Start asking, how exposed am I to this gamma risk and am I being compensated for it? Am I getting paid enough for the decay I'm taking on? Does this structure make sense at this time and point of day for this trade based on what's already in my portfolio? That's the level of thinking that makes zero DT more than just a coin flip. That's how you move from reactive trading to intentional trading. The overnight risk illusion. One of the biggest selling points you hear with zero DT trading is this: you have no overnight risk. You get in, you get out, you go home, you sleep easy. And that's true, mechanically. But here's what I want you to think about. Is the absence of overnight risk actually giving you an advantage, or is it just giving you a false sense of security? Let's be clear. Not holding positions overnight does remove some exposure. There's no earnings surprise, no geopolitical events that hit the futures at 2 a.m. in the morning while you're asleep, no gap up or gap down after the open. But that doesn't make the trade better necessarily. It just makes the clock shorter. No overnight exposure is convenient, but don't confuse convenience with safety. The real question here isn't when you're in the trade, it's the structure of the trade, meaning what strategy are you using to capture gains? How exposed are you to the price movements, and how much time decay are you getting compensated for that? And can you protect against volatility shifts? And does this setup make sense for the current conditions? If your trade is overly sensitive to small moves, if your reward is tiny compared to the risk you're taking on, or if the market isn't moving and you need it to, that's a fragile setup, whether you hold it for 10 hours or 10 minutes or 10 days. So if you're trading 0DT just to avoid being at risk overnight, that's understandable. No overnight exposure might feel cleaner. But if your trade is misaligned with price, movement, volatility, or decay you're getting paid for, it can unravel in minutes. You have to understand your trade if you actually want to lower your risk. I have plenty of videos on my channel with specific strategies to managing risk, so be sure to check those out after this video. The cost of execution is a killer and you don't see it coming. You can build a good trade, you can be right about the direction, and you could time it reasonably well, and you still may not make money. Why? Because costs quietly eat away at your edge and your risk premium. You can look at this graph and see how much money retail traders lose after commissions and fees. Almost 60% of people's losses in 0DT as retail traders can be attributed to transaction cost. When most traders think about costs, they think about broker commissions and small fees that they pay to trade 0DT. But those are just the beginning. The real killer is executional drag, crossing the bid-ask spread multiple times using too complex of orders. Slippage, which is the difference between the price you wanted to exit at and the price you actually get filled at. Poor pricing and gamma spikes during high volatility events. All of that hits hard because these are the costs you pay to get into a trade and that the broker and exchange charge you to take that trade. Even when traders win, fees slowly eat away at your P&L. And when you lose, they dig you into an even deeper hole. It's death by 1,000 cuts, and it's completely invincible until you look at your net P&L and your trade log over time and get honest with how much you're really paying on those commissions and fees and how you structure your trades. Most brokerage platforms don't do a great job of showing why your outcome is less than you thought it was. This is where you need to get into the details and be honest with how much of your trade P&L you're paying to these executional costs. Don't just ask, will this trade work? But instead ask this, will this trade still work after all executional friction and cost of execution? Because if your strategy only works when you get perfect fills, you don't have a strategy, you have a wish. So let's bring it all together. 0DT options are fast, flexible, and growing in popularity for good reason. But the popularity doesn't change the fact that they're unforgiving when traded without intention. If you've made it this far, here's what I hope you take away from this video. Understand the forces that are in play with 0DT options. The trade-off between gamma and theta aren't just terms, but they're the engine and the countdown clock for your option position. Don't confuse short duration with lower risk. Overnight exposure isn't a problem as long as you're structured well. Be aware of your drag. If your edge can't survive a little bit of slippage, it's not going to. And most importantly, only trade 0DT when your trade earns its place in your portfolio through rigorous back testing and forward testing. If this helped shift how you think about trading 0DT options, or if it gave you a clear sense of what not to do, hit that subscribe button. Let me know in the comments below if there's a specific part you want me to go deeper in for strategy videos in the future, whether that be implied volatility and realized volatility filtering, order execution. I'm happy to share more behind the scene looks on how I trade 0DT. Thank you for watching, and I'll see you guys on the next one.